Private equity giant Blackstone out with its second quarter results a short while ago. The company missed analyst profit and revenue forecasts, but it realized $40 billion worth of inflows and $34 billion worth of deployment in the quarter, reflecting the highest level of investment activity in 2 years, making a big bet on real estate. It called the bottom a couple months ago. For more on the new numbers and the economy, we want to bring in Blackstone President and Chief Operating Officer Jon Gray. Jon, it's nice to see you, sir.
Nice to be here, Andrew.
So help us with this. You did say that you thought the real estate business had bottomed out and you were going to shift into buying mode. Where do you think things really are, and how does the real estate piece of your business match up with everything else?
Well, Andrew, it's great to be with you. I'm going to just start a little bit on the quarter overall because you hit on it. For us, it was a strong quarter because we see a bunch of positive forward indicators. And the biggest one is this deployment of capital, including what we committed to is more than $53 billion. And we invested that capital because we want to invest before the all clear sign. When you talk about real estate and other areas, before the Fed cuts rate, you want to put money in the ground, and that's what we're doing. We're also benefiting as the markets heal here a bit. And as you said, more than nearly $40 billion of inflows. And we've been doing some of this in our favorite sectors like artificial intelligence, infrastructure, power, what we see happening in India and private credit. On real estate specifically, we said it at the beginning of the year on our fourth quarter call. We said we thought things were clearing. It was a better environment, really with the exception of office, which has some real headwinds. And we said it because we thought cost of capital was coming down. Borrowing costs were coming down. CMBS market was reopening. It was much easier to access capital. And that gave us a lot of confidence. And we've seen since then property prices stabilize and start to move up a bit. And as you said, we deployed a bunch of capital around that. And as investors, I think the challenge is when the news is bad from things that happened in the past, you really have to separate that and look forward. And on the ground, cost of capital was coming down, fundamentals were stable, less new supply, and all of that gave us confidence in what we did after the financial crisis, and we're doing it again now, and we feel very good about that for our firm.
What is the House view then about interest rates and when the Fed might move, given that you're trying to get ahead effectively of that move?
What I would say is the inflation data is very constructive for the Fed. Their medicine is working. When we survey our enormous number of portfolio companies every quarter, we ask them a bunch of questions. One of the questions we ask them is, how difficult is it to hire workers? And this quarter, it was the least difficult it's been going back to the first quarter of 21. We asked them, what do you think about wages a year out? They said this quarter, they think it's going to be about 3.25%, the lowest that's been in a number of years. And so the labor market is certainly cooling, wage pressures coming off. That helps the Fed. The other thing we'd say, going back to real estate, shelter costs are much lower than what's in the Fed data. That's going to come down as well. And so I think the picture may not be a straight line down on inflation, but I think the Fed's going to continue to get some pretty good numbers. That will allow them to reduce interest rates. And of course, that's helpful for the economy. And it's particularly helpful for our business in terms of what it means for valuations.
Right. What do you think of where we are in the cycle in terms of your ability, and by the way, your peers' ability to exit investments? One of the things that's happened, as you know so very well, is that pension funds, especially in the United States, have not gotten any money back from many of the private equity firms in the business. And so they're out of cash to keep putting a lot of new money in. It's getting harder and harder and harder. And so the question is, when do you think there's a churn so there can be some meaningful exits?
Well, I think you have to step back and think about the cycle. What's happened here, of course, is in response to inflation, the Fed took the cost of capital from 0 to 5.5%, and that created a shock to the system. And so we saw M&A volumes fall 60%, IPO volumes fall 90+%. And now, as markets normalize, as inflation comes down, as the 10-year Treasury comes down, as debt markets come down, borrowing costs get easier, the IPO market should get a little bit better. You'll start to see realizations pick up. And that's what we've begun to see in our secondaries business, where we're a massive investor in other people's funds. In this quarter, we saw a 30% increase in distributions, now off of a low base. So I think it's a matter of time. If you think about it as a cycle, in this early part of the cycle of the capital markets recovery, you try to deploy a bunch of capital against this. And then as things normalize, you begin to take out assets through IPOs and sales. That starts to look better. And as I think about our firm, if the current market environment continues to strengthen, we're still early in mid-24, but a year like 2025 could be robust for sales activity.